By the end of this video, you will know how to invest your money without losing it. That's a novel concept, I know, but if you are a retiree or near retirement, this video is for you. I'm David with Grammatical Investors Club. Let's get right into it. So this question comes from a recently retired couple. They're 65 and 67. They have income primarily from two sources, a private and public pension each, and Social Security. And their income covers their monthly living expenses. So they're in a fortunate situation with that. They do have a little bit of private savings that came from an old 401k from an employer that they rolled into an IRA. And it's currently sitting there doing nothing. And they said, I know we need to do something with this money, but we don't know what to do. And we don't want to put it in anything where we might lose it. So their primary concern is losing this money. They didn't say anything about needing to get income from it to live on or needing it to grow to a certain amount. They just said we don't want to lose it. So we'll talk about the 5 options of where they could invest their money. And I'll actually talk more broadly than just how you might invest inside of an IRA. We'll talk about if you had any money of any kind, how you might invest it. 5 different ways. And then 4 considerations that you need to make as a retiree in particular when you're considering all of these investment options. So let's start with the 5 and we'll break them all down. Number 1, it's actually not an investment option. It's the do nothing option. You can do what this retired couple is currently doing. You can just hold the money. You can stick it under your mattress. You can put it in your checking account or in an IRA, in a cash account, whatever, where it earns nothing and it's just sitting there. So that's option 1. And actually, I think a lot of people do that option. But we'll talk about why that's not a great one. Number 2, you can also buy and hold something and hope that that thing goes up in value. This is the speculative option. Buy a thing, hold it, and hope that it grows in value and that someone will pay you more for that thing someday. Also sometimes referred to as like an inflation hedge option. Number 3, you can lend the money to someone and you can get interest back from them and then your principal back. So this is commonly done through CDs or bonds, sometimes annuities. We'll talk about those options as well. Number 4, you can invest in productive assets like real estate, farmland, something like that. Or you can, number 5, invest in a productive enterprise like a business, which you might do through stocks or through a private business. So these are the 5 options. Let's start with number 1. Stick your money under a mattress method. This is the worst method because while it might seem like it's the only one that guarantees your money won't go anywhere, it's actually the only one that guarantees your money will lose value. If you do nothing, if you stick your money under the mattress, inflation will eat away its value. $1 50 years ago, that's been under a mattress for 50 years, is still $1 nominally. But it cannot buy the same thing today that it could have bought 50 years ago. It probably could have bought 10 loaves of bread 50 years ago, and today it can buy 1/10 of a loaf of bread. So inflation is crushing the value of that money. Even if it looks like the same amount is there, it's actually significantly less in real terms the longer you hold it. I like to think about money, and I think this is a good conceptual kind of metaphor for like what money is. I like to think about it as a debt that society owes you. So I got this notion from a book called The 7 Kinds of Inflation, written by a guy named Richard Dana Skinner in the mid-1930s, right on the heels of the Great Depression. And he talks about debt as an IOU from society. So you use this example of, you're a farmer and you grow 1,000 bushels of wheat and, they have a value of $1,000. And you could go and sell them for $1,000 and have $1,000 cash. And then you want to go and buy a car that's worth $1,000. So 1,000 bushels of wheat is equal to the value of a car. But we don't live in a barter society, so you're not going to go trade the bushels of wheat to the guy with the car. So what you do is you sell it to other people. Those other people give you little pieces of paper that are IOUs. So now you've got 1,000 of these $1 IOUs. And you can go and collect your debt from anyone else in society. You can go and trade that IOU in for a thing of real value. You produced a thing of real value. And in return for the thing you produced, the 1,000 bushels of wheat, you get back something that represents real value. and you can eventually trade it for an actual object or an actual service of real value. So you grow 1,000 bushels of wheat, and that's equivalent to what a car is worth. Well, let's say you get that $1,000 and you don't need a car today, and you end up waiting 10 years. And 10 years later, you decide to go buy that car. And it turns out that 10 years later, the car is worth $2,000. And you're like, it's gone up, it's doubled in price over the course of 10 years. But perhaps also so has a bushel of wheat. Maybe 1,000 bushels of wheat is now also worth $2,000. But the bushel of wheat you grew was 10 years ago. So you got compensated for work you did 10 years ago. This is very much like what you've done in retirement. Like, you just worked for 40 years. You got paid for 40 years. I'm sure your starting salary 40 years ago was very different than what your ending salary was. And so you're being compensated for the work you're doing in terms of what its value is at that time. And society is giving you these IOU notes, and you can take those IOU notes and stick them under your mattress and claim them for something else someday. But you're going to find out that when you go to claim your goods or services later with them, that the thing has that those IOU notes have not gone up in value, but the goods or services you want to trade them for have gone up in value. Now, there's another option of what you could do with those IOU notes. Rather than just stick it under the mattress, you could take it and you could, buy a piece of gold. And you could say, all right, well, look, I have 1,000 bushels of wheat, and those are worth $1,000, and the car's worth 1,000. And 10 years from now, they're both worth 2,000. And maybe 50 years from now, they're both worth 30,000. They kind of are more or less moving up in price together. Like they are still in relationship to each other the same price, even though inflation is reducing the value of my currency and thus making them more expensive in terms of actual dollars. So what you could do is buy something like a piece of gold and say, hey, this is my inflation hedge. It's also a bit of a speculative hedge. I'm assuming someone else is going to pay me more for gold someday. And I'm assuming that the value of my gold, if 1,000 bushels of wheat is worth 1 ounce of gold, I assume 100 years from now, 1,000 bushels of wheat will still be worth 1 ounce of gold. So my ounce of gold should maintain its value. I use gold as, it's kind of it's the gold standard, as they say. I use gold or precious metals as an example, but there are pitfalls to these. If you know anything about the silver market and what happened when the Hunt brothers a couple decades ago tried to corner the silver market, you know that the price of commodities and precious metals can go up and down rapidly. They can experience the same type of volatility that you might see in stocks or other investments. And so there's no guarantee. I mean, if you had bought silver at its peak prices during the silver mania a few decades ago, you probably would still not have recouped the value of what you spent. And so these asset classes can be subject to bubbles. That's one thing. And the other thing is that they're not productive. You're almost like hoping for inflation. Like if you buy a piece of gold, gold becomes more valuable as inflation occurs. And so it's like you're kind of rooting for inflation because that's how your gold's going up in value. But if you think about also like the tax implications of it, let's assume you pay taxes when you buy and sell gold and you report all your income appropriately. If you bought gold for $1 an ounce and then you sold it for $1,000 an ounce, you've had a gain of $999, and you would owe capital gains taxes on that $999, even if the reason it went up was because of the inflation of currency over that time. You don't get to deduct out inflation when you have to pay your taxes. It's baked into what you have to pay in taxes. So you're going to end up actually losing money. If you bought gold, it went up in value, you sold it, and you had to pay the capital gains taxes for the time you held it, and gold had moved at the same rate that inflation had occurred, then you would have lost money after taxes. So it's not my favorite asset class, also because, again, it doesn't produce anything. Let's jump to the third option here, which is lending. Typically, that's done when you get a CD at a bank, a certificate of deposit, or even you're just holding your money in a savings account at a bank, or like a high yield interest rate. Some bank accounts today, I'm making this in Q4 of 2023. Some bank accounts today, savings accounts, are paying over 4%, 4 to 5% interest, and you'll see CDs and bonds also offering fairly attractive interest rates today for what they've been over the last decade plus. But fundamentally, understand what you're doing when you buy a bond. You can go on Google and research everything there is to know about bonds and CDs, comparing them, comparing different CD options from different banks, some that have penalties, some that have no penalties. There's things to consider with bonds. Bonds can be treated, have different tax treatments depending on what type of bond it is or who the issuer is. There's sovereign bonds, municipality bonds, bonds from private companies. So there's a whole world out there. But conceptually, what you're doing is loaning your money to someone and getting paid interest and getting paid back your principal. That is the fundamental concept here. And so understanding how that works can also help determine whether or not it's a good option for you. And that's going to be highly dependent on whether or not you need that money to be easily accessible and liquid. Like, do I need to be able to sell this thing that I own at the drop of a hat and get that money back? Or is it something I plan to hold for the duration of the contract, as it might be with a bond or CD? Think about what happens when you buy a bond. When you purchase a bond, let's say from the US government for $1,000, and it's a 10-year bond and it pays 2%. That means you're going to get paid $20 a year for 10 years, and at the end of 10 years, you'll get your $1,000 back. And if you're doing this with a U.S. Treasury bill, it's the U.S. government that is paying that to you. That would be considered the, quote, safest or most risk-free investment in the world. It's considered risk-free because the U.S. government has never defaulted on a bond, not that they can't, and because the U.S. government borrows in their own currency. So the U.S. government is paying you in US dollars, and the US government can print more US dollars if they need them. So in theory, they should never default on a bond payment because they can just print the money to make the payment. That will, of course, have other effects on the currency. But at the very least, you would think it's sort of riskless because of that built-in capability. You know, Coca-Cola can give you a bond as well, and they're not allowed to print their own money. I guess they could print Coke bucks, but they wouldn't be any good. So when you think about investing in a bond, you might think that that's a really safe thing for me to do as a retiree. But if you know anything about what's happened over the last couple years, we had a extreme change in interest rates from 2 years ago to today. So 2-3 years ago in the 2020, 2021 COVID world, interest rates were extremely low. Because the government wanted to encourage borrowing. And so if you had bought a bond 2 years ago, you might be getting a very low rate on it, like 2%, let's say. And then today, fast forward to, the Federal Reserve's raised interest rates quite a bit. You could buy the same bond today and get 4% interest rate on it. Well, if I paid $1,000 to buy a bond that pays me $20 a year, and now that same bond could be purchased and it's paying $40 a year, and I wanted to sell my bond, somebody would only give me $500 for my bond that pays $20 because if a $1,000 investment is yielding $40, a $500 investment that yields 20 is the same 4% yield. So I would have lost essentially $500 of value. I would have bought a $1,000 bond, and that bond is now, if I were to sell it, would only give me $500 back. Now I could hold my bond to the end of the 10-year term. I could continue collecting the $20, and then I could get my $1,000 back. So you have to think with a bond that, yes, the money's there. Yes, maybe the U.S. government is good for it, but timing is a concern here too. Do I plan to hold this money until the end of the bond's duration? Or do I or might I need to sell it before that duration, in which case the bond's price itself can be volatile. And when I go to sell it, I may not get my $1,000 back. So that is a consideration that you have to have. I'm not going to go in depth on annuities here because there's a lot to say, but I'm just going to say don't. And maybe I'll make another video on why not. But the concept is not too different. You're giving a large chunk of money to somebody else and they're going to guarantee a payment to you. But with the fees, the transaction costs, the possible penalties, this is rarely the best option for somebody. I guess I shouldn't say it could never be the best option, but I don't know the situation in which I would recommend that as the first and only thing that somebody should do. Okay, so we've gone through the mattress method, the buy and hold and speculate method, the lend out your money method, and that leaves us with the last two, which is buy a productive asset or buy a productive enterprise. So a productive asset, I'm mainly thinking here about real estate. It should work in theory similar to the way buying gold would work. If you buy farmland, it should go up in value as inflation occurs. They're as it's been said, I think by Mark Twain, they're not making more of it. So whereas they are still, believe it or not, finding more gold every year. So while the value of the one should kind of diminish as more of it's found, the value of land should not change. But it also has productive capabilities. It's not just a speculative hedge. It's not just like buying even like a collectible, a fancy baseball card or a Pokemon card or a piece of art, and where you're hoping that somebody someday will pay more. There's no reason they should pay more other than they want it, and inflation has occurred, so at least the inflation increase in value has been baked in. But with land, it also has the ability to produce. So like land physically can produce crops, or maybe there are mineral deposits or whatever, right? There's or lumber, it can actually physically produce tangible real life goods that humans want. It can also serve as a cash flowing vehicle if you lease it out to somebody else who maybe can put it to productive use. So you can buy a piece of land, or you can buy a piece of real estate, a rental house or something, and you can lease that to someone else. So the thing itself should go up in value over the long term, and the thing itself can be used productively and generate income for you. Now, there are more than one retiree, I'm sure, who will watch this and who might own real estate and might say, hey, it's not worth all the work. There are different ways to do real estate, whether or not you're managing it yourself, or you're working with a management company, or you're just buying into something like a REIT, a real estate investment trust, or now there are all sorts of apps and other securitization type vehicles, these companies that can, crowdsource money to invest in a real estate project, and you get some cut of profits from the project, or some, sort of dividend payments from it. And I'm not here to hawk any products, so I'm not even going to mention any of them, but you can look them up. There are multiple ways to get into real estate. I think Jeff Bezos is actually working on a way right now to securitize all the single family homes in America, where you can, sell 1% of your home to this guy and sell 1% to that guy. And everybody's house in America's value is going to start going like this, just like the stock market. So can't wait for that day to happen. But there are ways to do this. And again, if maybe you're talking about a small amount of money here, like, hey, I've got $3,000. I'm not trying, I'm not going to buy a farm or a rental house with my $3,000. So is this really available to me as an investment, especially if I've got this money in an IRA or something? Well, again, there are vehicles like REITs that you can kind of simulate this. Or get the same sort of risk exposure. Now, speaking of risk exposure in real estate, yes, they're not making more land. Yes, if you buy farmland, even if it's not put to productive use and it just continues to sit there, it should go up in value over time, theoretically, unless something bad happens to a nuclear bomb falls on the land and it's, poisoned for the rest of time. So things like that could happen. But let's say outside of those possible risks, there are also speculative risks. Like there have been real estate bubbles. We are probably right now in the popping moments of a big commercial real estate bust. If you had bought an office building, a Class B office building in 2018, you'd be very unhappy with yourself right now because your returns have been horrible. You've probably lost maybe at least 50% of your investment over the last 5 years, with work remote and the value of office properties plummeting. So there are absolutely bubbles, and we also saw this famously in 2007, 8, 9, the crash of the housing market and the great financial crisis. Bubbles exist in real estate just like they can exist in any other asset. And the other danger with real estate is that people use leverage there more than they use in any other asset class. People don't borrow money to stick it under their mattress. They don't borrow money usually to buy gold. They don't borrow money usually to then lend it to somebody else. I shouldn't say that. The average regular person like you and me doesn't borrow money to then go buy a treasury bill usually. And less so, again, borrowing money to buy productive enterprises. But it is commonly used. It's like the way it's used is for real estate. So there's always the risk that you're over leveraged and things like that. So I'm not necessarily recommending real estate as a better option than just sticking money in a bond. It's certainly much more easy to stick money in a bond. You're much more liquid sticking money in a bond. But if your concern is, well, I don't want this thing to lose its value, you'll notice a running trend here so far, which is timing matters a lot and your holding period matters a lot. And it matters probably the most with this final asset class, which is investing in a productive enterprise, a business. So that can be a private business. Maybe you buy a local car wash, or you invest in a franchise of a Quiznos or something. I don't even know. Is Quiznos still around? I'm not sure. A Jersey Mike's. Or you invest in a publicly traded company, a very liquid market, in the stock market. The beautiful thing about doing this, and why over the long term this asset class outproduces all the others and generates the best returns, is that you've got sort of multiple axes on which value can be assessed. So there's tangible value for a business. Think of like a restaurant. They might own the physical building. They might own all the equipment inside of the restaurant. So you have like real estate that's being owned. You have tangible assets inside of the business that, maybe they got an autographed picture of Elvis on the wall. Hey, that thing can go up in value. So the business itself might have assets that themselves have value separate from the business operating. Like even if the restaurant shuts down and never makes more money, just the business sitting there, the building sitting there might continue to appreciate in value. Well, the building may not, but the land it sits on probably would. So you also have sort of the speculative element of investing in specifically public stock markets. If you are buying Apple, you buy a share of Apple, you're an owner of Apple's business. Now, Apple, again, has physical, tangible assets. They have cash in the bank. They have real estate. They have proprietary technology. They have all sorts of things that are themselves tangibly of value. And you have the fact that people will either pay more or less for their ownership stake in Apple, depending perhaps on how they feel. For more on that, watch my video on Mr. Market. But there's that element to owning a business as well. And then finally, there's the cash flow abilities of those businesses. So you have this local restaurant, again, that has a building and it has equipment, and it's all worth something. But the business is worth much more if that building and that equipment can be put to use and people can employ their labor and produce more income than it costs for them to produce the product they're selling. So, if you're selling pizzas for $20 a pizza and it only costs you $15 to make the pizza, then you've got a nice little profit margin there of $5 on every pizza you sell. And so the business itself could be valued based on its cash flows. So the issue, while this is the by far the most superior of the options for the long term, the issue, of course, is time horizon. So if you are planning to own a stock for a day, and you're going to need this money tomorrow. So I want to buy a stock today and I'm going to sell it tomorrow, but it's the best thing I can do with it today. I would tell you that is a terrible decision. Owning stock for a day is very bad. Owning it for a lifetime could be very good. I believe actually Warren Buffett said something similar to that. Stocks are a very bad investment for a day, but they're a great investment for a decade or a century or a lifetime. So the four things you need to consider, and we've kind of touched on these as we went through the asset classes, are, first of all, what are your plans with this money? Are you going to need to live on it? Are you planning to spend it? Or are you planning to pass it on as an inheritance? Are you planning to give it to charity? Whatever or is it maybe just a rainy day fund? Hey, if something happens, we have this, we have a medical emergency, our car breaks down, and we need to pull out more cash than we have coming in from our monthly income. We have this there as sort of an emergency account. If that's the case, then you're probably going to be best off keeping it in its most liquid form, something close to the under the mattress method. I would say probably putting it in a high yield savings account. You're going to at least earn some interest on it, whatever the prevailing interest rates are, but it's quickly accessible. And it's not going to suffer the fluctuations in value the way a bond might. You might lock in a good rate with a bond right now for the next 10 years, but if you expect that money is going to be spent in the next 2 years, it may not be a great investment. Of course, interest rates could drop and the value of your bond could go up quite a bit. So there is upside potential there. But it starts with, first, what are your plans? And the most important piece of that is, what's your holding period? So the best thing you can do to give yourself insurance that the value of this money is not going to deteriorate is not entirely tied to what asset it's invested in. It's more so, how long do you plan to hold it? If you can extend your holding period, then what you do is give yourself greater insurance that it is going to increase in value, because you'll have more of an ability to put it into something like a business enterprise or into land, something where you can trust that its value is going to go up over the long term. I don't need this today. I don't even expect to need it in 10 or 20 years. This is probably money that's going to end up in my estate. Well, if we're also lucky to have a scenario like that, it's great. But the point here is that the asset itself is not the most important consideration, or at least it's not the only consideration. You also have to think about what your plans are and your time horizon for how long you plan to hold it. You would also consider with this your income needs. Maybe the point is, you don't want to spend this money, but you would like if it generated some income so that you could spend that money. Obviously, in that scenario, then a bond might be the best option. The most secure bond being a sovereign's bond, a bond issued by a government. So whatever government of your country is issuing bonds, you might look to that first. And if you're in the U.S., you're lucky to have the U.S. Treasury as the one who's making payments on your bonds, because they've never defaulted and they can print more if they need to. So far, that's worked out okay. We'll see how long that works. But if you're thinking about loss in terms of permanent loss, what's the likelihood of permanently losing this money? Like, I put it in and it disappears, it's gone. So we've already talked about, the mattress method is the most likely. Like, over the long arc of history, money is going to zero. That was Charlie Munger, Warren Buffett's business partner, who just recently passed away, said his working hypothesis is that over the next century, the value of currency is going to zero. And that's true. Whether it's kind of an asymptote and it gets close to zero but never quite gets there, the point is money is continuing to lose its value constantly. The other thing you want to consider is what your tolerance is for volatility. So one of the reasons I think a lot of people who are real estate investors like it or gravitate towards it is their personality. They don't like... They might be more inclined to feel comfortable holding things for long periods of time and not worrying about on a day-to-day basis what it's worth. Whereas if you're invested in a public stock market, you can see the value of your holdings every day. The stock price moves constantly, and it might feel like today your stocks are worth a lot less than they were yesterday, and that might really scare you. Whereas investing in real estate, the changes in price are more like trends over the course of months and years. So you might not know, like the value of your house probably hasn't changed a lot from September to October, October to November. Maybe it has a little bit, but I don't know that you would think that differently about it. If I told you, it's worth $1,000 more today than it was 30 days ago, it'd be kind of like, okay, it's still like there's a ballpark value for it that I'm comfortable with. And that's not the case with stocks. You can know at any given moment what someone's willing to buy or sell your stock for. Again, watch that video on Mr. Market for more about the understanding the psychology of this. So if you are concerned about permanently losing your money, do nothing with it. Or buy lotto tickets with it. Actually, that's the surest way. If your odds of winning the lottery are like 1 in 300 million, then the likelihood when you buy a ticket that you're going to lose is like 99.99999%, right? It's like if one lotto ticket wins 299,999,999 are losers. And so the likelihood of loss is virtually assured. It's just as assured as losing your money through inflation. If you can't hold anything longer than a short-term period, then you shouldn't probably be doing anything other than putting money in a high-yield savings account. Maybe a CD or a bond with 3-month or 6-month or 9-month terms would be most appropriate for you. And then at the end of the term, maybe you just roll it into another one and you just kind of keep doing that. But the money would be accessible on a short-term basis. And if you're considering the options of buying and holding gold or collectibles or something like that, I would ask you to kind of check if you're doing that out of an actual belief that this will be anything more than just what inflation is eating away in your money, or if you're doing it out of speculation. And if speculation is what you're hoping for, if you're hoping that this purchase is going to result in a big payday, I would suggest that you're probably thinking about it incorrectly. And you might even check yourself to look around and say, hey, are other people, is there kind of a speculative frenzy happening right now? There's sort of an adverse selection effect that happens when things become really popular, Bitcoin, and people all start piling in at once to all buy and the prices start to go up. There's some adverse selection in when people become interested in things. And you're likely to have an adverse outcome if you're overpaying for something, which is very possible for assets that are subject to speculative swings. And so of the 5 options, the mattress is the worst unless you're spending that money tomorrow. The bonds, CD, the lend and get paid money back income might be the best if income is a priority for you, or you can be certain that you're going to hold it for the time horizon that you're signing up for. I generally don't think that buying and holding assets like gold or speculative assets is necessarily great, although there are some that have performed really well, interestingly. But I think that that's not possible to predict, is the point. I think somebody said Legos have been the best performing collectible asset of the last, 40 years or something like that. Like if you had like an original Star Wars set of Legos from 30 years ago, it's compounded at like 12 or 15% a year or something. It's like outpaced all other asset classes. But it's a guess as to whether or not that would continue. And there have been plenty of things people thought would become worth a lot that never did. Tulips in the 1600, are Beanie Babies worth anything? Maybe I might be, off base on that. But I think there's a lot of things people buy thinking they'll be worth something and then they aren't. And then obviously productive assets are the best if you can have a longer time horizon and if you're comfortable with, if you're able to ignore volatility. So I'm not sure if that was the answer that the folks who asked this question were looking for, and I'm not sure if it's helpful to you or not, but I think at the very least, if you can understand philosophically what you're doing when you're investing, and then understanding the important elements for you, how comfortable are you with volatility, what's your holding period, what are your income needs, what are your liquidity needs, if you can look at the different investment options available to you while considering what your needs are, then you'll be able to make an informed decision, and all the other stuff is just details. But start with the big picture. Well, guys, that's it. Again, I'm David with Grammatical Investors Club. If you like this content, please give us a thumbs up. Please subscribe. We'll be doing more of this in the future, and I hope that you'll continue to engage in the conversation. If you have questions, please leave them below. I love to get long-winded about whatever you're thinking about. Thanks, guys.